Hello, everybody. Welcome to Chloethedev Unfiltered, the paper reviews. So the paper review that we are doing for the day is the ETH2 economic review. So on the top corner, you can see the name of the paper. I did move the paper over to Google Docs so that I can start highlighting easier over. So for example, now I can highlight a little better and show where I am I can highlight over graphs and show which graph I'm talking about. And so I'll see if this is easier for me to go through or harder or whatnot. I will use the original paper just to show, or the online paper to show the table of contents. So we went through the executive summary, the introduction, the background, the framework they used for evaluating economic security in ETH2, the economics of ETH2. We went through all the participation, rewards, penalties, slashing, cost, takeaways. Went through the model walkthrough, which is just kind of the setting with which to frame ourselves before actually going through this paper. And then we got through the network. Now we're going through the network yields. So let's get started. So, illustrating network outputs using base assumptions. So, using the above base assumptions, we went through them in chapter 6, we illustrate a few key outputs of the model on the network average basis. So, this is what we're going to have on average. Exhibit 8, network average yields and network inflation. So we're going to be able to find a more detailed net yields and revenue net yield spread in Appendix C, which we're not going to go through right now, but we'll be able to get a pretty basic table here. I'm going to try and see if I can show it all on screen at the same time, but we're going to get through it. So this green line in this graph represents the revenue yields. The green line right below it is the net yields with ETH at $1,500. And the yellow line below that is the net yields with ETH at $25. And so that's supposed to show you like what your yield will be like at different prices of ETH. Let's see. And then how much ETH is staking. So on the bottom left-hand corner, you could see, with zero, with not a lot of ETH staking, and then all the way up to 33.6 million ETH being staked, and you can kind of, skipping block production for expired slot, your machine could be overloaded. Ooh, that's not good. Let me check on my node real quick. Up here I have my rocket pool node. My machine could be overloaded. Well, maybe because I'm going live at the same time. It's very interesting. Skipping block production for expired slot. But I assumed that my validators weren't even... let's see. Awaiting activation. Yeah, if they're awaiting activation... I'm wondering why it's trying to tell me that there's a warning. We'll see. Anyway, let's keep going with the paper. Then you have Exhibit 9, the revenue yield data table. Again, showing you ETH from the price of $25 to $1,500. It is showing you, based on the amount of ETH staked, what your yield would be. So in this Exhibit 9, it seems to be showing that the network yield should be consistent across the price of ETH. But the main difference I see here in Exhibit 10, and I'm sure they're going to maybe explain it below, but Exhibit 10, the revenue yield data table and the average net yields. So this shows that at $25 price of ETH, the more ETH that is staked, your net yield will come down, I'm assuming, off that base stake from 14.4% all the way down. I guess if the price of ETH stays at $25 and 33 million ETH was staked, the net yield for the network for wide would be -3%. See, that's kind of confusing. And this refers to the network average across all deployment types. So it's kind of hard to read the graph, I'd say, just because these are all averaged out. So you're going to have certain deployments where they expect things to be in the positive, certain things in the negative. But I guess what they're saying is if the price of ETH stays low, there is some potential issues there. And they're going to compare net yields. So Exhibit 11, yields of validated environments at the 0.524 million total ETH staked, which is the Genesis requirement. So I guess that's why they used in these graphs the first amount for total ETH staked is 0.52 because that's the minimum for Genesis to start the chain. Okay, so this is the exhibit. Sorry, it's kind of hard to read on the Google Docs. Maybe I'll bring it through here. It's a little easier. Anyways, I just can't click the charts, which isn't really that big of a deal. So again, from $20 to $1,500 pretty much. It's showing now a little bit of what you could expect. So, this brown line, it's pretty, honestly, it's basically saying costs pretty much even out for most people once you hit an ETH price around $650, $700. Which is why, in my opinion, it's one of these things where so at these low prices, you could see how there's negative yields for a lot of different validator types all down here. So doing it yourself is not bad, right? But like this blue line being pulled in a cloud is you're gonna lose yield and all that stuff. So, but once ETH kind of ticks up into this range here, I wish I could have a pointer and explain what I'm talking about. Maybe I can do it here. No, I can't. I need a way to never mind. There's no way to not on here anyways. To easily go in and click things. Oops, not trying to edit, not trying to comment. Anyways, gonna stay here for a little bit. The reader will notice a substantial change in revenue yield as staked increases, as well as clear yield differences in deployment types, which become particularly important as the price of ETH decreases. So if the price of ETH is high and everyone's happy, then the deployment type doesn't matter too much. Your yield should be fine. Your yield will go down as more ETH is staked, but the price of ETH should not really change your deployment type. Now, if you look at the more yield that is staked, you will get less yield, right? So at the beginning, you're expecting maybe 20% a year, which is awesome, but that'll quickly with double the amount of ETH here in this chart. At 1.2 million ETH staked, you're almost going by half. Once you get down up to 5-10 million ETH staked, you're looking at a normal 5% a year yield. But 5% a year with ETH price of 1,000 or something like that becomes a lot more secure and a lot more steady of a yield. And this is the yield sources. And this is where you're going to get your money as a validator, or where you get your funds. So you get rewards for proposing blocks, but you only propose one block per epoch, as far as I recall. So because you're only proposing one block per epoch, that blue line at the bottom is pretty small. A large part of your reward is going to be the block attester reward, that voting on each block saying which block is correct, which block is not correct. So that's a pretty big chunk of your reward. Friendly finality gadget, FFG source reward, FFG target reward, the FFG head reward, and then you have whistleblower reward. I guess whistleblower rewards aren't shown here because those are probably going to be I would assume very client specific. Like, for example, you might have some clients that run a little bit faster. You might have some clients that are able to, really focus on validating proofs and finding, being whistleblowers and getting those extra funds. Or you also have individuals who tweak their individual nodes or validators to be able to do these things. I think that'll be very interesting. Exhibit 14, the minimal shift in rewards as total ETH staked scales. Okay, so what they're saying is the actual percent of rewards that you're getting from each action is not going to change drastically. Okay. Here it's saying whistleblower rewards showing it as 0. Penalties are the same. Base fee 0. Slashings does change a little bit. There's more. The slashing weight is higher with less ETH staked, and it does increase, which makes sense because if there's less ETH staked, there's less overall security with which to play around with. But with 33 million plus ETH staked, you would assume you'd have more ETH to play around with in terms of security. Therefore, it wouldn't be as big of a deal. But yeah. Annual issuance at 0.524 million. Total as staked, which is a Genesis requirement. So yeah, now we're just going through the annual issuance of ETH. Because the rewards are given in ETH2, you'll see the annual issuance. It's kind of difficult to understand fully, because here you see the total annual issuance is 114,000 ETH, which I guess isn't too bad. But that's at only point. But then it shows you what's going to happen if almost a third of the network ends up staking. What you're going to see is almost 1 million. See this big gray bar on the right? Total annual issuance. Almost 1 million ETH per year. I wonder what this decrease is fully from. But yeah, we'll see. So some slashings. They're saying you'll lose 82 ETH in slashings. I would assume more than that, but hey, we'll see. World War III model. The exhibit below illustrates the network issuance conditions under scenarios with low level of online validators. The shape of the curves reflects an accelerating inactivity penalty, which is then progressively negated by lower always happens. Lower active balances of the validators, which the inactivity penalty impacts. After 30 days, the offline validators are completely exited from the chain. So 30 days is all you have. After 30 days, you're out. The below charts illustrate the design of the inactivity penalty, which reduces ETH from inactive validators, thus increasing the percentage of ETH staked from online validators. Assuming stability in the number of online-offline validators, eventually the ETH staked from online validators will exceed that two-thirds ratio again, which will mean we could reach finality. This event occurs every 22 days if 50% of nodes are online, and only 30 days if only 1/3 of validators are online. It's crazy. Although I feel like my node must be exited from the network now, my first node, because oh wait, there's no point of trying to reset it then. Now I know 30 days is all I had, so I'm probably out. So yeah, as you can see, it just drops and it just switches at the 22-day mark. And then here, 30-day mark, it just completely exits someone or completely, Using narrower parameters. The following exhibits illustrate network conditions using ETH price with a more narrow historical range and up to 5 million total ETH staked. Bad, oh bad. So this is the network average yields and network inflation. This blue line coming across the screen going up is the inflation, right? And you'd see as there was more ETH stake, there'd be higher, there'd be more inflation. But this is just showing with 5 million staked, not the extremes. So again, before we were looking at like $25 to $1,500. Now this range we're looking at is between $75 to $300, and what those revenue yields would be in that level. So it looks pretty reasonable. We'd start at 21.78% on the top left, the green line, and then with 5 million ETH staked, you're looking at 7% yield on ETH, which in my opinion is quite reasonable for helping to secure the network and getting this return in ETH. And then I would hope that the price of like these derivatives on ETH hold at least half ETH's value. So let's say we have about 5 million staking and you're staking a rocket pool node. I would then assume you're looking at about 3.5% per year. And then obviously you could, then provide some liquidity for NETH and ETH, and I think that's probably what the Marlon J Foundation is going to try and do. Exhibit 20, revenue yield data table, network average in USD. So again, this is just going from, instead of having that big line at the top, the red one, let me go back and show you. This red line up here, we were going from 14% yield down to -3% yield if ETH stayed that low of a price. Now we're able to look at a more a normal yield where we're saying, okay, you know what, we're always going to be starting at pretty much 21% as long as the ETH price is $75, which, I mean, for all intents and purposes, I don't think the developers would release a beacon chain contract to attach to if ETH was below $100 at all. I mean, right now we're above all this chart. I think ETH right now is about 380. So all of this should be well within reasonable grounds. I think, 500,000 ETH staked, I don't think it's very much. I think we'll hit that very reasonably. And I think this chart from like the price of ETH staying the same should help us understand that this is the yield we should be looking towards. I think it'll be very easy to hit 5 million ETH staked. It's less than 5% of the total ETH supply, and I think that yields then would drop to around 5% per year, or less. But that's my personal assumptions. This is the net yields again. So let's see, revenue yields, and this is net yields. Okay, so this is now bringing down your net yield after you've become a validator. So as you can see, your net yield is going to go up. So here, your revenue yield will stay the same at the 7.1%, but your net yield is going to increase closer and closer to that I'm talking about the 5 million ETH staked part of it. So let's look at just the farthest right column. A validator will be able to get closer and closer to that 7.1 number as the price of ETH goes up. So you can kind of see that while this chart is what you're looking for in terms of what your validator can max out at, these are more realistic numbers, and then these are the spreads. So this is very helpful to see at a low price of ETH, your spread is quite large. And as the ETH price goes up, that spread tightens, and you're able to, increase your profit. And then, honestly, I'm not going to go through all these. These are all the exact same analysis. We're going through what happens if the price of ETH is low, right, between $10 and $100, and this is all very important to understand, what kind of yields you're looking at. And again, what I think is important is looking at if ETH has a flash crash in price while you're staking. I think that's more why these low ETH price analysis are important, because yes, right now the ETH price is at $400, whatever, 380. But if there's a week-long or a month-long progression towards, $100 to $10 prices for like 2 weeks to a month, it can cause a lot of stress on the validators. And if you have been staking for for 6 months at the price of $1,000, and all of a sudden there's a month-long lull of $100 ETH price, that might cause a lot of network instability, people trying to exit the network, people buying new nodes to average out. I think Uniswap's LPing is going to help provide a lot of stability for this. Is because the whole value locked is becoming actually locked these days, or a lot harder to move at least. Okay, then you have the exact same spreads. So then what are our takeaways? From these outputs, we conclude high yields at the maximum ETH staked for Genesis. The revenue yield at the minimum at ETH staked requirement for Genesis, 524,288 ETH staked, equates to approximately 21.8%. At this amount, network average net yields range from 14.4% to 20.5% between ETH prices of 25 to 1500 and total network issuance of 0.1%. These are very attractive yields when compared to traditional yield-bearing instruments. I agree. Ranging near yields of high-yield bonds, triple C rated corporate debt yielding, 14.7% at the time of this writing. But the lack of liquidity and volatility of the underlying asset might make capital-efficient validators hesitate to hold the underlying asset, ETH locked up in ETH2 directly. We address the Genesis level of ETH staked in our scenario analysis. I do think this is a large issue. I think it'll hopefully be mitigated by companies like Rocket Pool, and I know other derivatives as well, going to be creating ETH2 derivatives that people can start trading. I know EOS was traded had a year-long ICO and traded from 25 cents to over $1 during its ICO. I think that this is going to be similar. What I see it is this is a 2-year ICO like EOS, except for it's decentralized, it's distributed, and it gives enough time for anyone to get involved. So if you're really hardcore and you're really involved, you could start at Genesis at launch. You could start a few weeks later, probably a few months later with Rocket Pool. You could start with an exchange. There's many ways to get started, and along that 2-year journey, move yourself from wherever you are now along a decentralized journey. So if you start by staking on an exchange like Binance or Coinbase, hopefully eventually you might want a beacon node for fun, connect a validator to, maybe not even connect any validators to it, just run a beacon node for fun, learn how that works. I know a lot of times part of the issue is that, you can connect to a beacon node through an API as well, which I think is really cool. So NIM, I think one of the big things NIM is going to try and do is have validators be mobile first, and then just pay 5% of your yield to an API provider that makes sure you connect to a safe beacon node. And I think that'll be super cool, the ability to kind of always have your validator online, have your money right there. And if you're able to have a Rocket Pool set up with NIM, you'd be able to at least use those funds within the network and gain some actual ETH out of it. And so that's kind of where I see a lot of this going. I see how it's going is can you just create yield and use that yield to do what you need to do, to run projects, to run your business, to bootstrap what you got to do. Significant reliance on stable ETH price. That's why I think Uniswap plays a huge pull with all their stable coin to ETH pools. As indicated by the revenue net yield spreads, net yields tumble when the price of ETH falls below roughly $100. So when you read this, you realize all this stuff, these key takeaways are important. ETH needs to keep a price, if we're just keeping it really simple, above $100, which is completely fine. But what that means is that how do we do that? How do we give a stable value to ETH, this economic value? I think stable coins and pegging stable coins to ETH is on Uniswap and other dexes is a wonderful way to do that. Demonstrating the level of resilience of the network on ETH price. In contrast, yields begin to show little movement at a price point of $500. So above $500, you're pretty much good to go. With costs plateauing as a percentage of total rewards. The lack of ETH price resilience is a major concern and potential attack vector for adversaries. For example, forcing a flash crash of the network, which will destabilize validator yield. So if you got to make sure it's hard to create a flash crash. STAS providers offer stability to end validators by taking on fixed costs of validating. STAS could significantly de-risk the impact on validator yields if fees are represented as a percentage of validator rewards. So what they're saying here is, like instead of saying your base fee is $20 a month, regardless of what you make, what they could say is, you're going to pay 10% of your yield. So if your yield is $20, you pay 20% of that. If your yield is $1,000, you pay 20% of that. Which is mentioned prior is how cost assumptions account for STAS business models. STAS providers make more profit as the price of ETH increases because costs remain fixed while collected revenues in USD would increase. On the other hand, STAS providers would also bear the brunt of the low ETH yield cliff. See below for definition. Sustained levels of low ETH, less than $100, depending on what the STAS charges, could cost STAS providers millions of dollars in infrastructure and production engineering expenses. So this is one of those whole ideas where you charge percent-wise, and then all of a sudden, when infrastructure costs increase and the price of ETH goes low, you might go out of business. So, how does that work? Forcing the exit of their clients, i.e. the validators and or their business. Reviewing STAS policies when STAS products are launched with regards. So this is kind of what I'm interested in because I would like the Marma J Foundation to be a software provider to help people stake. For free, yes, I know, or for 1.19% or some silly like that. Because I'm going to do this stuff anyways. If I'm going to build this infrastructure anyways, then I want to help build it for free. I don't know how. I know how kind of, but I want to get into NIM. I want to help make it mobile first. I want to run a mail server, all that kind of stuff. The network is cost effective, but economies may scale. Economies of scale may still apply. Gosh, relative to proof of work networks where margins are stretched thin and only large scale capital intensive infrastructure, bulk ASICs or GPUs and complex power systems can make mining profitable. Economies of scale in the ETH to POS network decrease in magnitude as ETH price increases. Basically saying, as the ETH price increases, there's less of a reason to pool together with a bunch of other people and get your ETH, staked. There should be just as much as an incentive with proof of work and Ethereum 2 to get your one node and stake by yourself, or maybe 2 or 3 nodes. But as the ETH price increases, so $500, $1,000, $2,000, $5,000 maybe one day. But as the ETH price increases, it is more viable to only have 1 or 2 nodes. As the ETH price is lower, it is less viable. And this is where, the Marma J Foundation doesn't really have enough funds in ETH to really do much. But, we could potentially provide the infrastructure to run a solid beacon node, which would, a solid beacon node, a solid mail server, which would allow for other people to connect. So up to 1,000 nodes, up to 1,000 validators. So for example, if we had 1,000 validators connected to our node, we could be charging, let's say 1% on each validator, and that would be the equivalent of the Marma J Foundation having 10 nodes. So that kind of stuff, obviously you have infrastructure costs and networking costs and everything else. But if I was planning on running a node regardless, it seems as though it makes sense to allow for 10,000 nodes validators to connect, which would allow, let's say either way, we're making a profit for the foundation by offering a very low cost service to the community. From above, it seems like it's normally going to cost around 5%. I would love to offer that, for free at the beginning to learn, and then offer it for a bit more after, just to help out the community. And now everyone can get involved. For illustrative purposes, we categorize ETH price into three graded regions: cliff, economies of scale, and stability. Stability is where we want to be at, probably. The cliff region represents extreme volatility in yields due to falling ETH prices. The economies of scale region is where larger scale environments have a clear cost advantage. That's where ETH price is low, and running a node on your own doesn't make sense. Even right now, I'd say we're at the economies of scale section, and stability is, hopefully with ETH in the $500 to $1,000 range, where potentially having 1-2 validators might make sense at home. This is because validators can run several thousand validators in the same deployment setup as a validator running only one, and at this ETH price, the difference between gross and net yield is still relatively important versus the stability range. At stability levels, gross yields, regardless of scale, fall closely in line with net yields, which is what where we want to be. There is a price threshold at stability level where there is an economic advantage to running one's own validator environment, supporting an incentive for greater decentralization. And I think this is the most important part of the paper we've read so far, is this line right here. I'll read it again. There is a price threshold at the stability level where we want to be, where there is an economic advantage to running one's own validator environment, supporting an incentive for greater decentralization. And I think that is the key of this entire ETH 2.0 thing. We're trying to take something like Bitcoin and make it Turing complete, which is how you got Ethereum. We have smart contracts and code can be run, and we can build all these crazy cool things. And then now we're trying to take Ethereum and make it proof of stake, so that we're having a more efficient system, so it can be more centralized, so this economy of scale thing is taken into the equation. And so instead of having these huge mining operations where I can't get involved, and I've been involved in the Ethereum community for a while now, and I can't get involved, it kind of sucks. In this new system, with an ETH price high enough, there's a level where whoever can get 32 ETH can stake at home and be economically viable. And I think that's really cool, because when you research that, there's all these people trying to get ETH to this level. From a security standpoint, it makes me more secure in purchasing ETH for this. Like, I'm not purchasing ETH for some economic investment. I'm not purchasing it for some, get rich quick scheme. It is solely for this line right here, so that eventually I can stake ETH at a price where it is economically incentivized, and where I'm economically incentivized to stay decentralized and run one validator and help the rest of the network, and it works out. So that is a goal I hope we get to, and I'm very excited for it. This is going to be, Exhibit 27, showing the network average yield at that Genesis amount, charting the three region yield analysis. So at that cliff level, it ain't looking good. Once you get to economies of scale, we get to this little range, I guess, depending the price of ETH, depending how much is staked, a lot of variables. And then you get this stability level where, first of all, yes, you still need, right? Like, I think you still need a certain level of ETH staked. I don't think you'd be able to get well, this is saying that at a certain ETH price, it doesn't even matter for the most part, right? And I think that's the beautiful thing. I mean, once we get to this, $1,000 ETH price, it seems as though the network works in a decentralized way. So I consider ETH to be like $1,000, from an economic security standpoint. Because above $1,000, it doesn't even matter to me, and below $1,000, we're still working towards economic security. Not just me, not just these researchers, but the entire Ethereum ecosystem is working towards ETH at $1,000. In my opinion, from what I see here, because that is when you get ETH 2.0 to have economic stability that is viable from what we've seen in the past, moving from proof of work to proof of stake, so we can have a more decentralized security system, or base level of security. The revenue net yield spread stabilizes at approximately 1% for the network average validator toward the higher end of ETH prices, primarily due to the fixed percent fee for SaaS validators. Self-managed environments, such as DIY environments, approach a near zero spread. So that's the plan for Marma J to be a self-managed environment, at least on a beacon chain level, and then to simply connect my own validator to that, and continue to allow others to connect their validators as well. That's the goal. That's the goal. And then you're gonna see, there's different charts. So this is the chart at 10 million ETH staked. This was a chart at 0.5 million ETH staked at Genesis. At 10 million ETH staked, this is where you see the problem. So in the beginning of the system, you can see how yields are quite high. I mean, 24% at the top here, 20% is what we're actually getting. Looks great. Here, you can see once 10 million ETH is staked, it's much more important to ensure, first of all, a high price of ETH. Look at the bottom here. Our current price of ETH at 379 right here, kind of in this area above. We're looking, I look and I see that the price of ETH plays a really big role on this curve, on what you're looking at as a validator. And there's some really high risk as that dips towards, $100 ETH price. You can see almost 0% yield for your validator from what you're running. Again, I don't plan on running things for economic incentives. I plan on running them for altruistic incentives, where they can be really cool. Because if you have enough altruistic nodes in the beginning with a low ETH price, then this curve, that curve at the end, shouldn't matter so much. Because what will happen is, yes, say the Marma J Foundation is losing on infrastructure costs, but it doesn't matter because everyone else is still gaining something on their validator, and so we are bearing the brunt of infrastructure costs, and validators are still profitable. I think papers like this do not take into account altruistic nodes, and that's a good thing. What you'd want is to see this is the most realistic scenario of what is expected, and then I think every bootstrapped network needs a high, or it is much easier to bootstrap a network when you have a large amount of altruistic nodes that are willing to do things for non-economic incentives. Or at least that's not their highest priority. In this section, we have shown the impact of the network's parameters on network issuance, gross yields, and net yield under various conditions. In particular, we have shown how sensitive the yields are to price and ETH staked. However, given the importance of yields in attracting ETH staked, it is useful to understand how ETH2 yields compare. In other words, we need an objective method for evaluating ETH2 yields to understand their expected impact on validators' decision-making when allocating capital, and the resulting impact on network security. So good chapter. A lot of graphs and stuff, so I guess I went through pretty quickly. Tomorrow I will go through chapter 8, a model for measuring required yield. And in about an hour I have the EIP-IP meeting for the Ethereum Foundation, and so I'm just gonna hop off here, get ready for that. I might actually go through a little bit of the ghost paper now, but I want to just kind of break these papers up, go through the chapter today, record them, and have them be shorter videos. So hope everyone enjoyed that, going through the paper. I actually enjoyed going through it here better than Google Docs, so I'm going to stick to that as well. Hope everyone has a wonderful day, and yeah,